Hi, my name's Lauren Goodwin, and I'm the Chief Market Strategist at New York Life Investments, based in New York. I'm here to share a U.S. investor's perspective on the key topics facing the markets today. And today, we'll talk about tariffs. Since the Trump administration started discussing and even imposing tariffs on other countries, a few key questions have arisen. What's the goal of tariffs? Will they be successful? And what impact will they have on the global economy? And how should investors change their portfolios as a result, if at all? Starting with the first question, investors have been asking whether the goal of tariffs is a negotiating tactic or more about trade and tariffs itself. And the answer is yes, it's both of those things. Both in his first administration and this time around, Trump has expressed displeasure with the US's large trade deficit with countries like Mexico, Canada, China, and Europe as well. And this is why these countries and regions are facing pressure faster. But there are other foreign policy goals to be addressed in these regions. With Mexico and Canada, immigration and drug trafficking are top of the list. With Europe, we believe that Trump is likely to try and use tariffs as a means of securing more funding from Europe for NATO defense. And in these cases, the US has a lot of leverage in its trade relationships and may be able to extract concessions on those foreign policy items. With China, though, the goal is broader and relates to national security, including security of the semiconductor supply chain that is viewed as such an important part of economic security in the long term. In this case, both the US and China have a lot of leverage on one another. China's relationship with Taiwan, its monopoly on silicon production, and ownership of many rare earth metals makes it less likely, in our view, that a deal would be quickly brokered. And so we do expect US tariffs to move higher globally, especially on China, which contributes to our forecast for higher US inflation and lower economic growth in the near term, the next 12 to 18 months. The Candriam economic team has done a great job mapping out specific implications for the various trade and policy change scenarios. But what can investors do about this? US inflation has been sticky, and near-term inflation expectations have moved significantly higher in response to tariff threats. Long-term inflation expectations have been relatively well anchored up to now, which suggests that the market still trusts the Fed to get inflation under control. However, upward momentum there would be very worrisome, and we believe the Fed is likely to be on pause for the next several months as a result of these concerns. So all this together points to a few clear asset allocation themes in our view. We remain fully invested amid resilient global growth and strong profit growth, especially in the US. But inflation risk and policy risk in the US keep yield risk, in our view, to the upside. So we have a short duration position to US fixed income as a result. We also believe that tariffs are part of a broader and longer term trend of re-globalization. Capital intensity and investment related to supply chains, electrification, and digitization and AI are impactful trends globally, allowing us to broaden equity exposure and take a more balanced approach in terms of sectors, including digital and energy infrastructure. Though a lot of focus is on US equities right now, the more accommodative monetary policy in geographies like Europe have contributed to faster credit growth and deal flow in some of these regions. And many global investors sitting in the US already have an underweight position on ex-US equity, so we're encouraging broader exposure there.